Good afternoon. We are with Evie Hambro of BlackRock Mining Trust. Evie has been part of the team at BlackRock running World Mining Trust since it started in 1993. And I think Evie's team is one of the biggest looking at natural resources companies globally. So we're very lucky to have Evie here. A bit of housekeeping. We're going to have time at the end for Q&A. There is a Q&A function at the bottom right-hand side of your screen, which you can please do ask questions, and I will address them to Evie for you at the end. I think that's about it. So, Evie, over to you.
Great. Billy, just checking you can hear me?
Absolutely.
Great, fantastic, and thank you very much for allowing me to do this. So we're going to go through a brief presentation. Goal is around 20-25 minutes. We're going to highlight some of the results of the investment trust, which were released not that long ago. And we'll touch on a few slides covering our outlook as well. So to start off with, last year's results were a little disappointing in terms of total return, but it was another excellent year when it comes to dividends. Very, very strong income generation for the year as a whole, coming in substantially ahead of expectations from the analysts, although down year on year as the underlying companies cut some of their dividend payments. Reflecting the payout ratios that they put in place 6 or 7 years ago now. What is also important to note is that the diversification of income really started to help again. The kind of I guess we were lucky enough to be swamped in dividend payments for the last couple of years, where the benefits of that diversification strategy didn't have the size of impact that they would normally do. But in this lower environment, hopefully we're continuing to smooth that journey when it comes to dividend payments from the trust versus the alternatives being the underlying companies. When we look at the total return for the year, as I said, that was disappointing. We were behind the 3 metrics that the board looks at, which is inflation, broader stock markets, principally the UK stock market, and the underlying sector. We'll touch on a little bit for the reasons there, but primarily some of the big wins that we'd had in prior years gave up some of their gains as interest rates started to increase, and we lost some ground against some of the North American steel names and some of the Asian steel names during the year, having focused our exposure elsewhere, which led to those relative losses versus our reference index. In terms of the discount and premium on the trust, I think we've been lucky enough to survive some of the bigger moves that we've seen of late. The trust kind of trading around that kind of plus or minus level, close to zero for most of the last few years. I think this is really a reflection of the fact that the performance has been pretty good. The underlying trends within the sector bode well for the future, and obviously the high level of income generation for the trust because of the payments we're receiving from our underlying companies. In terms of the total return since inception, it's important to point out to people that we've just crossed the 30-year anniversary for the trust. As Billy mentioned at the start, this was launched on the 15th of December 1993. So for £1 invested back then, you've had about £14 worth of return up until about December, a little bit less than that with the share price coming back over the last couple of months. But again, a pretty strong track record and way ahead of most of the alternatives that people tend to look at us against. You'll see also the mix of return partly coming from income, but also coming from total return of the underlying asset base. And this is really a reflection of the fact that when you look at the underlying sector, typically over 50% of the returns come through income over time because of the fact that it is a mining related investment, deeply cyclical, and a lot of those returns get paid out as dividends rather than coming through capital growth. In terms of the dividend track record, again, as I mentioned, last year was another great year with regards to income. Over 30p of dividends paid, 33.5p of dividends paid for the year. Again, a dividend that was fully covered by the underlying income that is generated by the portfolio. And the board stuck to their policy of distributing substantially all of the income generated during the year. And that was again followed through in 2023, as it has done for many of the last year since that policy was first put in place. And so for a pound investor, just to remind you again, you've now had about £3.5 worth of dividend that's been paid out to shareholders. Looking at the shape of income, as I touched on at the start of the presentation, we did see a fall in ordinary dividends. That was somewhat compensated for with the big increase in special dividends that were paid during the year, some of those linked to M&A transactions. But you'll also see the contributions coming from options, from royalties. And one thing I would like to touch on is that obviously with this higher interest rate environment, we are now moving back into an environment where it is becoming more attractive to focus in on those fixed income arbitrage opportunities that we've used in the past. When interest rates were low, the attractiveness there just wasn't enough, and we were able to get better returns elsewhere. But now we've seen interest rates rally, the cost of debt has risen for companies, and also, I guess, the withdrawal of many of banks from financing resource assets has meant that the cost of capital for some of those junior companies has risen quite substantially. So the attractiveness of this area has improved, and that we would hope to be able to find a number of opportunities to bolster that part of the income mix in 2024 and really starting to pay out in 2025. Another area that we always try and update people on is what we're doing on the unquoted side of the portfolio. Just by reminder, we have 2 royalty-related investments in the portfolio and 2 unquoted equity positions. The other 2 unquoted equity positions have IPO'd at very, very high premiums relative to the price that we paid for the underlying investments. So they've been successful in terms of getting liquidity events and an increase in value. Just by starting off on the royalty position, our main royalty is in Brazil. It is just by way of journey, we made this investment in 2014 with a $12 million investment backing a junior Australian company building out or planning to build out copper and gold mines in the Carajás in Brazil. What we've seen since then is that the company has changed hands twice, and the assets are now owned by BHP. This represents around 1.5% of the portfolio. Since making the investment of $12 million, we've had $27 million of payments back to us, and the current carrying value is just under £20 million based on the future royalty payments that are likely to come through over the remaining life of the asset. When we go on to the second royalty investments, these are also in Brazil. These are the ones linked to Vale's assets. This represents just under 3% of the portfolio. We've had some really fantastic returns on this investment since we actually had this investment at the IPO of Vale, but we increased it substantially in February 2019. And since then, as you can see from the chart, the payments really have gone up an enormous amount. And so we've had nearly all of our capital back on this investment in only the last 4.5 years since making it. So again, a pretty successful return. The current yield on the investment is just over 10%, which makes this a very attractive ongoing income producer for the trust. And the last one is much smaller. This is an early stage copper exploration business in Colombia. What's intriguing about this is that they really are in elephant country. They have a huge land package that they've partnered out to a number of international mining groups. Glencore, Rio Tinto, First Quantum are all in partnership with them doing the exploration work and spending the dollars on the ground. Some of the most recent exploration results from this business have come through very encouragingly indeed, and the company's just been going through a capital raising round, but at a substantial premium to the price that we paid for our shares, which underpins the current valuation, or more than underpins the current valuation that we're holding this at inside the portfolio. I think for this to get through to a liquidity event, we would need to see obviously a better market for juniors, but obviously what's encouraging right now is the recent strength in the copper market, which is really kind of lifting all of these opportunities in the listed part of the exchange, and so this bodes well for any future potential for this unquoted investment in the portfolio. Coming on to the trust itself, looking at the asset allocation, you can see this is the data as at the end of January. I think our end February data will be out in the next few days. These are our largest 10 positions. You can see the commodity mix, and you can see the gearing levels at around 12% at the end of January. One thing I would like to point out is recently some of the activities inside the portfolio that we've been focusing on is to maximizing our exposure to copper, and also making sure that we've taken profits in areas where the outlook for the commodity prices is less encouraging, and so those actions have been taking place over the last kind of couple of months as we've been updating in the monthly fact sheets. So this has resulted in a slight tilt in the portfolio over the last kind of, if you looked at it 6 months ago relative to where we are now, you will see some decent changes there, capturing the kind of the views that we have on the kind of near-term outlook for some of these commodities and commodity-related equities. Coming on to the sector as a whole, and what is the outlook and where do we go to from here? I think the first thing to say is that when we were thinking about this a year ago, the prospect for a China reopening was really very substantial. China had been in a zero COVID environment. The economy was very much operating on life support. As that zero COVID environment was removed, there were huge expectations that we were going to see a big bull market developing in China. What's happened is that the economy's kind of more stuttered to life rather than opened with a big fanfare, and there are obviously some concerns around the property part of the economy, which have kind of created a lot of negative sentiment towards China outlook and China related trades. The government has put in place a number of financial measures to support economic growth. It's been very targeted rather than kind of widespread, and that has really helped to underpin some of the areas of commodities demand, think related to, say, energy transition or electric vehicles and so on. So whilst we still have this negative sentiment overhang attached to China, it's been hard for commodity prices and in turn commodity related equities to really break through and to reflect their true fundamentals. And that's the headwind that we've been facing in the portfolio, both on where we're positioned, but also in trying to get those extra gains that we have in specific names inside the trust. Despite this kind of, I guess, that kind of headline opener, the underlying commodity markets remain extremely tight. Supply is very much constrained. There are a number of examples of this where we've seen production at existing assets disappoint again and again and again, and a number of supply disruptions coming through as well. With inventories as low as they are, any ease in that kind of negative sentiment towards China could create some pretty explosive moves in the underlying commodity prices, and hopefully the trust is positioned for that. That's certainly what we've been aiming to try and achieve. Over the medium to longer term, obviously the energy transition is going to be the key driver of demand. What's extraordinary is that whilst these very, very strong long-term picture remains massively intact, the underlying supply side is not having the investment to support the growth that's needed to feed the demand that's going to come through from that energy transition. And I think that's a function of rising capital costs, inflation, but also the fact that growth is not being rewarded in the investments by the market. And so what's been the point of the companies doing this? So they're returning capital to shareholders, they're buying back shares, and they're making decarbonization related investments rather than adding volumes, which again creates this kind of impending problem for the future, where demand is likely to outstrip supply at significant scale. In terms of some graphs that kind of capture some of the comments that I've made already, obviously the sector last year started pretty strongly with the enthusiasm around China, and I think as the data started to come through that showed that the picture wasn't as bright and the recovery of the economy wasn't going to be as strong, equity valuations moved lower, as did commodity prices, underperforming world markets as a whole. But as we got towards the end of the year, things started to settle down, and we actually saw some better pricing. The one that really surprised to the upside was iron ore, where prices were substantially ahead of expectations. Most people having anticipated iron ore prices to be down during 2023, whereas actually they finished the year quite up pretty strongly. As we look at some of the other commodities, you'll see the price of copper has been pretty much flat at around that kind of $4 a pound level over the last 3 years. Oil prices have been volatile, but again, trading at pretty healthy levels with regards to profitability. Nickel has been the one where we've seen a huge price collapse in the market, that predominantly as we've seen a lot of new supply coming out of Indonesia at very, very low cost that's been undermining the kind of higher cost operations that have dominated nickel production for generations. And again, you can see that iron ore price significantly exceeding expectations in 2023 versus what the market was going for. Coming back onto China, we've put some headlines in here from the news coverage, and you can see the journey through the year as a whole. It obviously started off with high expectations with regards to economic recovery, and then those mellowed and then became pretty negative towards the end of the year, kind of holding back anything related to China. And I think much of the muscle memory from the previous China-related bull market in commodities remains intact, and therefore commodity equities move up and down in relation to China sentiment. Often used as a tool to kind of extract beta from views on the Chinese economy. So that has held things back in 2023 relative to our expectations. Where are we going to with regards to the medium long term, looking at the energy transition? It's important just to reiterate this. I know we do in most of our presentations, we've talked about this for the last couple of years, but the numbers are worth repeating because they are just so substantial indeed. The amount of new materials that are needed to meet the picture for the energy transition globally is scarily large. We need way more commodities for this, renewable power, all of the associated infrastructure, the energy transition related to mobility and transportation is very, very materials intensive. We're going into an environment where the commodity intensity per unit of GDP in a lower carbon global economy is going to be dramatically higher than what we've been used to. The world has become ruthlessly efficient in terms of extracting energy from fossil fuels, and now we need to go through a phase of building out that infrastructure to move away from that and towards this lower carbon environment. And what's been fascinating over the last few weeks is just reading much of the commentary in the market around the growth of AI. All of that AI is going to be very energy intensive. The energy has to come from somewhere. If it's going to come from clean sources, it means more materials. You need to build out all of the data centers attached to this, and that is also commodity intensive. So the commodity intensity of this high technology economy that we're going into, again, is going to be another driving force, especially putting things like copper. The demand there is going to be pulled forward pretty substantially. In terms of what China's doing to support the economy, there are lots of initiatives, but it's not just China, it's other countries around the world that are driving this. You've seen a lot of the moves around the US IRA, the European Green Deal, all designed to try and support the supply of commodities, because I think governments realize how big the challenge is going to be with regards to this energy transition and how much more is needed. We're going into an environment where security of supply of commodities is going to be a very important factor when it comes to meeting the greener ambitions that many of these governments have over the next 10 to 30 years. What are the companies doing? You can see on the left-hand side here, this page, you can see the lower level of money that's being spent on expansionary capex. I think we've probably seen the trough there. A little bit more money is being spent today, but it's a fraction of what needs to be spent and a fraction of what used to be spent by the companies globally over the last kind of 20, 30 years. And I think there's one other interesting factor here, is that if you're thinking about where to spend money and what projects. In the past, the kind of, I guess, the green investments were more kind of nice to have projects, but now, because of the lower capital intensity, the improved performance of some of these investments, they are now starting to compete in terms of returns with some of the growthy options that companies might have. So there really is an interesting dilemma that companies are going to have to discuss and come to a conclusion on, is where do they allocate that spend? Do they spend it towards growth, or do they spend it towards decarbonisation? And if they stay within their dividend frameworks, the competition for capital there is going to be quite intense between those two strategies. So if anything, I think we're going to probably see more going towards decarbonisation as the business model on decarbonisation related investments starts to become clearer and the returns continue to get better. In terms of some of the supply side challenges, we've updated this slide. This shows you the challenges that Chile, the kind of Saudi Arabia of copper, faces with regards to trying to grow production. You can see that 2023's production was again very disappointing relative to their high growth ambitions, way below what they used to be able to produce in the past. And this would all be fine if the world didn't need more copper. When you have the world's largest producer unable to grow, it's a big challenge. It's not as if they're being held back by OPEC here. They just physically can't take that production up to the higher levels that the world really starts to need. When we look at copper in a bit more detail, what's interesting is if you take the kind of some of the kind of consensual views, which all point towards more copper being needed in the future, the spread of how much more really varies. And you can see some huge numbers here. If you look at mining companies, how much more is going to be needed over the next kind of 20 to 30 years. It's a massive amount of additional material that's going to be needed in terms of supply to meet the demand expectations. So the prospect of going into an environment where we're likely to see large deficits in the copper market playing out and forcing prices higher is very, very real. The other challenges that we're seeing here relate to capital intensity. The world's largest big new project was meant to come in at about $4 billion, $4.5 billion of capex, and it's coming in at around $9 billion of capex, around $30,000 a ton of annual capacity. In order to get a return on that kind of investment, you need to see a copper price that's a lot higher than where the market is trading right now. So these rising capital intensity rates are discouraging companies from building new capacity because the prices aren't high enough to get the returns they need on those investments. Hence the support from government trying to provide access to capital, etc., all trying to unblock some of these challenges because they know how much more is going to be needed in the future. The gold market's obviously been catching a lot of attention of late. We've seen some really interesting moves. You can see the traditional correlations here on the left-hand side of the page. But what's fascinating, though, to me is why the gold equities have lagged so badly relative to the move in the gold price. And we've seen a lot of views being put forward by people in this regard. I think the main one that I would point to is that the gold companies have been unable to capture much of that upside in rising profitability. Unlike a producer of, say, iron ore, where a lot of that increase in price flows through to the bottom line, much of the gold companies, much of that price increase has to then be spent in terms of capital expenditure to maintain production levels, going into exploration to find new sources of supply, because gold assets tend to be relatively short in terms of life. And so there's always a need for cash. And so far less of it has flown through to the pockets of the investors. And I think that's really held back many of the gold equities relative to the kind of move in the gold price itself. But what's also been interesting to note is how much more gold is now being bought by central banks that have been significant investors of late. And you can see some of the data that has been coming through in terms of rising activity there. So maybe they're worried about the long-term purchasing power of the US dollar. In terms of valuations, we continue to be at attractive levels in terms of valuations, especially when it comes to balance sheets. The resources sector, the mining sector, is very, very undergeared relative to the kind of broader market. You can see on the chart on the right-hand side, the net debt to EBITDA number at kind of just under 1 times, which is way below where it has been in the past. And in terms of broader multiples, again, a low levels relative to much of its own history, not quite at the record lows of a few months ago. Thankfully, we've got picked up a bit since then, but again, still it well into the kind of what you would describe as value or cheap territory relative to its own history and relative to broader markets. In terms of some of the initiatives the companies are going on, I think this brown to green initiative that the companies are all going down is very, very real. They are seeking to decarbonize their production bases as fast as possible to be able to meet climate objectives. But also, as I said earlier, some of the monetary benefits of doing this are starting to show through. And whether we start to see differential pricing coming through for commodities and higher returns being available to sell things, not just on the purity of the commodity, but other characteristics. That's a journey that we're going through at the moment. And I think the price discovery process is starting to become a bit clearer. And that brings me to the end of the presentation. So I'll hand back to Billy in case there are any questions. But thank you very much for your time.
Thank you so much, Evie. Yeah, this is your chance to ask Evie a mining-related question that you've possibly too frightened to ask in the past. Obviously, he's a global expert, so this is your opportunity. There's a couple so far. Is there a green premium in the highest scoring ESG companies, and do you see this? Do you see this changing in the future?
Yeah, it's a good question. I think there are two playbooks to think about here. What we've seen in the utilities space, as the utilities companies started to move away from fossil fuels and go towards renewables, the multiples that those businesses trade on expanded dramatically. And so, if that is a guide for the future, I think it is a pretty confident one, or it's one that we would have a lot of confidence in. If you look at the steel companies that have moved away from the kind of much more kind of carbon-intensive production processes and moved to things like electric arc and some of the new technologies that are starting to come through, the valuations that those businesses are on are dramatically higher than the businesses that haven't changed. So again, another trend that is clear. So I think the chances of this sector becoming better valued as it decarbonizes are very real. I think the other thing to say is that we're now seeing, I guess, greater clarity between customers and producers of commodities in terms of what they need. So if you're an automotive company that wants to reduce its carbon footprint in terms of a vehicle, if you can get the supply of green aluminium and green steel and green copper and so on and build that into your mix, then that has a big benefit to you through time. You have to remember that a large part of a vehicle's emissions over its life come from the manufacturing process, not just the fossil fuels that are burned as it operates. And so eliminating both sides of the equation is the pathway to getting to that very low emissions intensity number. And so there is a value for the supply of those commodities that are produced in that particular way. And we're starting to see that play out. There are different prices being paid for this. The challenge is that the supply of these commodities remains tiny. There isn't enough really to have a kind of clear price discovery process because the volumes need to grow. But I'm very confident that this is really starting to come through, and we'll see more information on this in the near term.
Thanks, Evie. Comment on uranium?
Absolutely, yeah. We've seen a huge increase in the price of uranium from its lows to where we were a few weeks ago. It's come off a little bit from its highs. That's obviously driven massive moves in uranium stocks, and our single biggest positive contributor in the trust in 2023 was our holding in Cameco, which was a big part of the return mix. That company has been through a number of kind of cycles, I suppose, through time, and I guess the uranium market now is becoming increasingly seen as integral to the energy transition. The need for baseload power and low carbon baseload power is an essential component of the overall mix for the global economy. And so I think as people have started to understand that and the role therefore of nuclear, that has flowed through into impacts on uranium pricing, and we've seen this massive move. in the price of the commodity. I think it's unlikely that we're going to give much of that back. You've got to remember that the uranium market is the spot market in uranium is tiny relative to the total consumption picture. So you do get these very volatile moves in prices. The real money is made with these long-term contracts between producers and utilities, and I'm pleased to say that we're well positioned in that regard.
Great news. Do you have any exposure to sort of rare earths?
We do. We have 2 companies in the portfolio that are exposed there. We've actually did very, very well for most of the last kind of 5 years. And last year was a tough year in that space. The price of rare earths came back pretty sharply, and those 2 companies were impacted by that, so they lost some ground. And I think one of the things that everyone needs to understand about the rare earths market is dominated by China. China controls around 90% of supply. So if they don't want too many people investing in rare earths globally and them losing their market share, then prices tend to go lower. And I think a little bit of that kind of game was happening last year. And so we've seen some kind of price weakness coming through. It wouldn't surprise me if that was to correct. These price falls don't tend to last very long.
Any thoughts on which battery metal will prevail between cobalt, lithium, or nickel?
Well, I think they've all got different characteristics. I think the one that's probably most at risk from, I guess, its price volatility and its role has been cobalt. The one that seems to be integral to all of the new technologies, I say all loosely, nearly all of the new technologies in relation to battery chemistry is lithium. So I think that one's going to be an integral part of that for many, many years. So for the time being, I would say lithium has probably got the best role.
Thank you. And maybe just summarise what your approach is to the environmental and social impacts of mineral extraction.
Absolutely. What we try to do is obviously invest in the companies that have, the best possible track records, but also we're very conscious of value, and that does tend to mix those 2 agendas. If we can find a company that has a really, really positive change after having been through a bad period, and we're very, very clear about that in the annual report in terms of setting this out. So I would suggest anyone to read that. If we can believe that a company is going to become substantially better, has a robust plan to change culturally after meeting with management and visiting assets, we can see evidence of that. Then when a company might still be in the kind of, I guess, ESG penalty box for things that have happened in the past, if we can believe things are going to get better, we will back them on that journey, because there is a value-based opportunity of supporting a company during that period of recovery, and that can be very accretive. So it's supportive of the positive ESG journey, but also there's a chance of value creation for the trust as well with regards to its investment. So I think that probably differentiates us a bit, rather than just having a blanket-based exclusion, which I think the majority of people tend to do.
Thanks, Evie. Can the BlackRock mining share price make progress without a strong China recovery?
I think what we need to see, as I said at the start of the presentation, is we need to see some clarity around China. We don't necessarily need to see a huge recovery. That would be a massive help. What we just need to see is some easing of the negative sentiment. So I think if once people stop thinking that things are going to get worse, that's going to be the first step. But that's the kind of 30,000-foot view. What you can't ignore is the tightness of the underlying fundamentals. So nothing substantially has changed when it comes to China in the last few weeks, but we've seen this huge move in the price of copper. So despite the negative sentiment there, the underlying physical fundamentals in the copper market are playing through and driving the price in the short term. So I think the clarity on China would be a huge help, but the physical fundamentals are also just as powerful. And if when they really start to exert themselves, as what we're seeing in copper right now, that takes a life of its own.
Thanks, Evie. Last one. What's the opportunity set in sort of unquoted and higher rates, which obviously increase the cost of capital?
Yeah, great
companies?
question. Yeah, I think what we've seen in the last few years is we've been in a number of processes to try and make investments and broaden out that unquoted part of the portfolio. We've made 4 pretty successful ones so far. 2 we've had those IPO events, so they've moved into the listed part of the portfolio, and we've been able to take profits in. And we've still got 2 remaining private equity or private positions in the equities of companies in the portfolio. On the royalty side, again, we've been involved in a number of processes, but given the low interest rates and what some people were prepared to pay for these things, we just couldn't get the returns that we needed to. So we had to stick to ourselves being disciplined in terms of what we were after. What we've seen now is we've seen interest rates change, and we've seen the valuations of many of these things contract substantially, and so the opportunities are actually coming to us rather than us having to find them. So it wouldn't surprise me if we were able to find a number of things in this area over the near term to be able to deploy capital into, which is pretty exciting. Certainly some of the conversations we've been having over the last kind of 6 months, it made me pretty confident on that.
It's encouraging. Evie, thank you so much for your time, and thank you all for dialing in for this Monday lunchtime session. The presentation will be available on our website in a couple of days, so there. Then tomorrow, we have International Biotonic Trust presenting, starting at 12 o'clock midday. So thank you so much, Evie, once again. Thank you all for dialing in.
Great. Thanks very much, everybody. Good luck. Bye.